Right, let's have a look at this question then, all about over trading. Now it says use suitable working capital ratios. So what working capital ratios do we know? Definitely the current ratio. We would probably also want to do something on receivables. So receivable days, inventory days, and then when you look at it, look, it's all up here. Current ratio, quick ratio, inventory days, receivable days, payable days, could do sales revenue to net working capital as well. Okay, now in this, I'm not going to do the actual ratios for you. I'm sure you can work them out yourselves. What I'm going to concentrate on is this over trading bit. So it says that using the ratios and analysis of the financial information, evaluate whether this company is over trading or not. So what I would do to answer a question like this, it's a full 12 marks. The first thing is I want to state a bit of knowledge, but I'm going to be really specific. I want to state what over trading really is. Okay, and over trading is when we are expanding. Beyond our usual capital limits so that we become undercapitalised. Something along those lines, in your own words, doesn't really matter. But basically what I'm saying is that define overtrading. It's where we expand so quickly, we don't use enough long-term finance and we become over-dependent on short-term finance. And that puts us at real risk of going bust because the short-term finance is overdraft and an overdraft can be called in at any time, can't it? So you define overtrading and then we're going to have a look and we'll say, right, let's have a look. Is this company overtrading? The first signs of overtrading is a huge increase in revenue. So what I would do, I would probably work that out as a percentage. See what the percentage increase looks to me if it's gone up about 40%. Okay, now that's gone up 40%, but the profits do not go up by 40%. They hardly go up at all. Okay, and I'd say that's the first example of overtrading. So I'll just write the examples down here. A big increase in revenue, but not such a big increase in profits. Now that's not enough. You say, well, why would that be? And you say that's because we are concentrating on profitability. When you're over trading, you're trying to become as profitable as you can. You're trying to get in as many sales as you can. And in doing so, what we might be doing, we might be reducing the sales price to get more sales in. Okay, so that's what we could be doing here with over trading. Now, what else have we got then to suggest that we are over trading? Well, it says use the ratios. So the average ratios for the current ratio was 1.7 times. And then what we'd have to do is work out our current ratio for this year. So our current ratio for this year would be, let me just make sure we're using the right, yeah. So it would be your current assets, which is the 5349, over your current liabilities, which is the 4365, and that is definitely less than 1.7. So the current ratio, obviously, in the real exam, you would work that out. But in the real exam, you work it out. I'm concentrating on the overtrading bit. So I would say that current ratio has gone down, and I would say probably why it's gone down. With it going down, this is a symptom of overtrading, and that is because of the increase in the revenue. Okay, so the current ratio falling because of the increase in the overdraft. I mean, okay, do the same for the quick ratios. Now let's have a look at inventory days. Inventory days 55. We would expect inventory days to be increasing. So let's go and have a look at inventory. All right, you can see you could do this as well. The inventory days will have increased without me having to do it, but you could see that inventory has doubled by the looks of it, and yet revenue hasn't doubled. So I'd probably put that in as well. Okay, so that's another point, as well as working out the inventory days. Remember, inventory days would be inventory divided by cost of sales times by 365. Okay, I've done this question before. I can tell you it does increase, and you have to say, right, that's another symptom of overtrading. Why would it be? Because we don't want any stock outs. So what we've done is we've made sure we've always made sales by having lots of stock, but now we might be stuck with that stock a little bit. Receivable days, you'd do the same thing. Work out the receivable days. I'd also do the same thing, working out what's happened to receivables as a whole. Again, it seems to have virtually doubled, and revenue hasn't virtually doubled. So revenue's going up. Trade receivables should go up in the same manner, but it's not. It's going beyond that. So we do that. We do the receivable days, and we'd say, why? Why would this be happening? And maybe we are giving extra credit terms in order to get more money, in order to make more sales. Okay, and this is increasing that. Now, because we've got this big increase in our current assets from 2826 to 5349, we've got that big increase. But where are we getting? Because it's inventory, because it's receivable, it's not actually cash to us. So where are we getting this cash from? And you can see the cash is coming from the overdraft. So the overdraft has hugely increased. You'd say that's a symptom of overtrading. And the other thing that's hugely increased is trade payables. I do the payable days, they will have increased. I'd mentioned the overdraft, how that has increased a lot. And that, what we're saying is, overall, is we are now relying on our overdraft and our payables to support our investment in revenue, to support our investment in, not in revenue, in receivables and in inventory. And so this is what overtrading is. We start getting too much stock, too much receivables, desperate to make sales, but we're not getting enough long-term capital. We're relying too much on short-term capital. Okay, and if you look at the long-term capital, you would say, look, those have stayed the same. There's been no issue with shares. There's been no long-term issue. We are relying purely on trade payables and overdraft. We are undercapitalised, and that's what it's often called. It's often called undercapitalisation. It's called thin capitalisation, and that's how you work through it. You'd also probably just finish off by working out that as well. And then, have we got the 12 marks? You bet your bottom dollar we have.